Station 1.
Mr. Chairman, Mr. Vice Chairman, my name is Andy Peake, and I'm from New York City. First, congratulations to you on a remarkable 50 years. And second, thank you for hosting a one-of-a-kind annual meeting where you patiently answer questions from shareholders. I believe you are both...
Thank you.
I believe you are two of the most knowledgeable and authoritative people on planet Earth on the U.S. tax code. Our tax code is obviously broken at both the individual and the corporate levels. Today we have 2.1 trillion in offshore corporate cash sitting there, not being brought home. We have the highest corporate tax rates in the world. And for high income earners in the U.S., other than hedge fund managers, in states like New York and California, an all-in rate greater than 50%. What can be done to effect real change to bring about a simpler, more rational tax code? Thank you.
Well, it takes 218 members of the House of Representatives and 51 U.S. senators and a president that will sign the bill. The question is how much you think the country should spend, and then from whom do you get it? And I would point out that despite the tax rates that all the corporate chieftains complain about, the share of earnings, a share of GDP accounted for by corporate profits is at a record. Corporate taxes 40 years ago were 4% of GDP. They're now running about 2%. They've decreased significantly while payroll taxes have increased. It's a real question. And once you get special provisions in the code, it is really hard to get rid of them absent a major revision of the code. I actually think, I may be an optimist on this, but I think both Ron Wyden and Orrin Hatch, the two members of the ranking members, Senate Finance Committee, I think they're capable of working out something that neither one of them likes, but they both like it better than what exists now, and I think it can be made considerably more rational. But in the end, if we're going to spend 21 or 2% of GDP, we should probably raise 19% of GDP. We can take a gap of a couple percent without getting further into debt as a proportion of GDP than we are. So we've got that leeway. But you take 19% of 17.5 trillion or thereabouts, and you're talking, as Senator Dirksen said one time, real money. And how much you get from corporations, how much you get from individuals, how much you get from estate taxes, it's a fight up and down the line. And in terms of the cash abroad, basically you can bring it back. You just have to pay tax at U.S. corporate rates. And our corporate rates are 35%. Charlie and I, a good bit of our life, operated with corporate rates at 52%, later at 48%. And the country grew well. American business prospered during that period. I don't shed any tears for American business in terms of the tax rate overall. I think there could be a much more equitable code in terms of the corporate tax. But I do not think that the 2% of GDP that's being raised from corporate taxes, which is far lower than was the percentage 30 or 40 years ago, I do not think that's an onerous number. And for people who are getting 1/4 or 0.5% on their CDs who retired, and with American business earning on tangible equity, which is the way to measure it, probably averaging close to 15%. I think equity holders are getting treated extraordinarily well compared to debt holders in this economy. Charlie?
Well, I agree with you, and I don't die over in the tax code either. I live in California, of course, where there's like a 13.5% tax on long-term capital gains, non-deductible for federal purposes. That's a ridiculous kind of a tax to have in California because it drives the rich people out. Hawaii and Florida have enough sense to know that rich people don't commit a lot of crimes, they don't burden the schools, they provide a whole lot of medical expenditures that are good for everybody else's income. I think California has a really stupid tax policy. But I don't think the U.S. policy is. I don't think the U.S. policy is bad at all.
And it's not deductible because of the alternative minimum tax?
Yes, exactly.
Yeah. That really wasn't the case before, but
it's always
kind
been
of slipped in.
They did it on purpose. No, they did it on purpose.
We're here, early stages of paranoia.
Yeah. But it's amazing. The idea of driving the rich people out. Florida is so much smarter than California on that subject. And it is really demented. Who in the hell doesn't want rich people coming in and spending in their state?
Yeah.
Yeah.
Remember that as you come here to Nebraska for the meeting. Yeah. I would say that I really do think there's some chance this year, and not a tiny chance. I know both Ron Wyden and Orrin Hatch. They're patriotic. They're smart. They want to do the right thing. They've got different ideas about what the right thing is. There's no question about that. But they also know they can't get any place without cooperating. I think the real opportunity is if they work out of the public eye in working on something like this. And I wouldn't be surprised if they are. I think that's the way to get it done. Charlie has always pointed out what would have happened if the Constitutional Convention back there in Philadelphia had been held with every delegate running out immediately to tell the TV cameras how right he was and how wrong everybody else was. It doesn't accomplish much to dig in on positions and not be in a position to compromise, because it takes a lot of compromise to write something when you have two fundamentally different views on some important aspects of the tax code. But those are two good guys, and I don't think it's impossible at all that we have a new corporate tax code within a year. Okay, station 7.
Hi, my name is Dan Hutner from Vermont. I was wondering if you could talk about Henry Singleton's Teledyne and whether you learned lessons from that, used it as a model, and what you think about how it ultimately unwound and how you might want Berkshire to continue differently.
Yeah, that's a very good question. And Charlie knew Henry Singleton. I knew a lot about him. I mean, I studied him very carefully, but Charlie knew him personally and as well as studying him. So I'm going to let Charlie answer that. But there's a lot to be learned from both what Singleton did in his operating years and then what happened subsequently.
Henry Singleton was very interesting. He was a lot smarter than either Warren or I. Henry was the kind of guy that always got 800 on every test and left early. And he could play chess blindfolded, just below the grandmaster level when he was an old man. That said, I watched him invest and I watched Warren invest, and Warren did a lot better. He just worked at it. Henry was thinking about inertial guidance and Warren was thinking about securities, and the extra work enabled Warren to get by with his horrible deficit of IQ compared to Henry. And the interesting thing about...
Let's not quantify it.
No. The interesting thing about Singleton is he had very clever incentives on all the key executives. And they were tough, and they were important, and they were meaningful. And in the end, he had 3 different Defense Departments that got into scandals. He wasn't doing anything wrong. He wasn't trying to hurt the Defense Department on purpose. But the incentives got so strong and the culture of performance got so strong that people actually went too far in dealing with the government. Teledyne did. And so we haven't had any trouble like that I know of. Can you think of any, Warren?
No, and Charlie and I, we really believe in the power of incentives, and there's these hidden incentives that we try to avoid. One, we have seen, both of us, more than once, really decent people misbehave because they felt that there was a loyalty to their CEO to to deliver certain numbers, because the CEO went out and made a lot of forecasts about what the company would earn. And if you go and say, if I were to say that Berkshire is going to earn X per share next year, and we have a bunch of executives in the insurance business that set loss reserves and do all kinds of things, or companies in other areas that can load up channels at the end of quarters, at the end of years. I've seen a lot of misbehavior that actually doesn't profit anybody financially, but it's been done merely because they don't want to make the CEO look bad in terms of his forecast, or he's done it because he doesn't want to look. When they get their ego involved, people do things that they shouldn't do. And so we try to eliminate incentives that would cause people to misbehave, not only for financial rewards, but for ego satisfaction. And I think that's probably pretty unusual to even be considering that in the business, but we've seen enough, so we do consider it.
I might also report that at the end, Henry wanted to sell his business to Berkshire for stock, so he was very smart of him, right to the very end.
We had a case at National. It's interesting. You really have to understand, should understand human behavior, and if you're going to run a business, because when National Indemnity, we're going back to the late 1960s, Jack Ringwalt was a marvelous man. He ran it, and he had another marvelous man who worked for him as his tennis partner, and that fellow was in charge of claims. And when the claims man would come into Jack and say, I just received a claim for $25,000 or something for some long-haul truck or something, Jack would say, it was just his personality. He would start berating the fellow and saying, how can you do this to me? And these claims are killing me and all of that. And he was joking. But the fellow he was joking with couldn't take it really, and he started hiding claims. And he stuck them in a drawer. And that caused us to not only misreport fairly minor figures, but it also caused us to misinform our reinsurers because they had an interest in the size of claims. And the fellow that was hiding the claims had no financial interest in doing it at all, but he just didn't like to walk into the office and have Jack kid him about the fact that he was failing him. And you really have to be very careful in the messages you send as a CEO. And if you tell your managers you never wanted to disappoint Wall Street and you want to report X per share, you may find that they start fudging figures to protect your predictions. And we try to avoid all that kind of behavior at Berkshire. We've just seen too much trouble with it.